Mark Sobel, U.S. Chair, OMFIF. In October, Scotiabank hosted a conference entitled Canada, the Americas, and the Global Economy, Investing in an Interconnected World. Scotiabank worked with OMFIF on that conference, and as a continuation today, I'm pleased and delighted to be joined by David Dodge and Jean-François Perrault. David Dodge needs no introduction, as he is well known across the globe for his outstanding and prominent career as Canada's former finance deputy and Bank of Canada governor. Jean-François Perrault is Scotia's senior vice president and chief economist, a former senior Canadian central bank and finance official who led the G20's macroeconomic framework group and suffered through G20 communique negotiations in part because of the then American negotiator. So let's get the show on the road. Jean-François, where does the global economic recovery stand and what's the outlook? China appears to be past the virus. In the advanced economies, we faced a second COVID wave, softening indicators, and the rollout of the vaccine is still a ways off. What's Scotia's take on the situation?
It's an interesting situation. I mean, we're in the camp of those that think there's going to be a reasonably solid recovery next year globally, in most countries, obviously led by China. But we're in this tricky period right now where, the really forward-looking indicators are pretty positive, right? We've got the vaccine. We know there's this light at the end of the tunnel. We're going to have the virus at some point behind us. We know there's fiscal stimulus coming in the U.S., whether it's kind of a short-term thing or a bigger Biden plan at some point in time. We know economies are going to rebound from the various lockdowns that are in place now. So, second quarter beyond, third quarter beyond, there's reason to be pretty optimistic. Problem is we got to get there. And in the short run, the COVID situation is really quite scary. You're seeing, pretty significant extensive lockdowns in Europe, a slowdown in economic activity. That's true North America as well. Policymakers are treating this with varying degrees of seriousness, and I guess we worry a little bit more about the U.S. in that context than anywhere else. So you've got this kind of tricky transition to negotiate. We're confident that things are going to be better. You've kind of got to cross the river before you get there, and the Christmas period is going to be awful. That's going to carry us into January, maybe February, in terms of the health-related consequences of that and the impact on economic activity. So if we can manage the next few weeks reasonably well, I think we're still set up for a pretty good recovery next year. Nothing outstanding, something like 4.25% for 5.25% for the global economy, which is a decent number, but coming off the very significant decline that we've seen, you're still looking at levels of economic activity that are pretty low relative to what we would have thought a year ago. So there's also this kind of level versus growth effect that we need to keep into account. So there's kind of this illusion of very strong growth next year that we got to temper with the reality that the situation is not going to be fixed, and therefore policymakers are going to be active, and that's why you're talking about the Fed, or seeing the Fed talk about the need for fiscal stimulus and tweaking this and that, and central bankers talking about interest rates being low for a very long period of time. This is a recognition that there's still a lot of work that needs to be done to try and get us back to some measure of normal, even though growth next year looks like it's going to be pretty damn strong.
Well, great. Thanks for that. And that's a good launching pad to get into broader policy issues. So let me start with the governor. So all the central banks in the advanced economies have slashed rates to zero or the effective lower bound. They've expanded their balance sheets. There's obviously more ammunition, forward guidance, lengthening the average maturities of holdings, yield curve control, more QE. They don't seem to like negative rates. But as a general proposition, monetary policy is less impactful around the zero lower bound. Do you think monetary policy in and of itself is largely spent? And if you think that, do you think the story changes if monetary policy and fiscal policy are coordinated, with central banks buying up the government paper, as another colleague of yours, Jean Boivin, has proposed?
Right. Well, as we well know, monetary policy operates with long and variable lags. And so let's not dismiss the fact that we are at the lower bound, are likely to stay there through certainly through 22. And as you say, yield curve control, keeping long rates down. mean, that is going to have an impact, maybe not right away, but that is going to have an impact. And hence, the right away issue, really then we turn to fiscal policy. And yes, we are building up a large pile of debt. Governments are building a large pile of debt, although that's offset a little bit by what's happening in the corporate and household sector, who are in fact repairing balance sheets or building up piles of cash at the same time. So one would expect, indeed, that in the short run, it's going to be fiscal policy that's going to do the job, and that is entirely appropriate. Central banks focusing on keeping a degree of monetary stimulus there, absolutely appropriate as they try to get the inflation rates back up to 2%. And so it's equally appropriate for governments at this point, certainly, to be borrowing like crazy and trying to inject some stimulus. I agree with Jean-François, though, that once we get into the second half of 21, I think there is going to be a fair bit of strength. And certainly we would hope that some of those savings, both corporate and household, are going to come back in the form of investment and consumption. So I think we will have a year, probably from summer to summer, of pretty strong growth. And if that is backed up, indeed, with a degree of stimulus, and certainly if that stimulus is put in the right place, i.e. oriented towards investment rather than towards consumption, I don't think we ought to be so pessimistic about where we're going to end up at the end of 22. And in fact, by the end of 22 or into 23, I would fully expect central banks operating against their own charter, in fact, are going to be reducing the amount of stimulus that they are providing, certainly on the QE side.
Thank you. Jean-François, do you have anything to add on monetary policy before I turn you to fiscal policy?
Yeah, maybe just quickly. There is, central bankers have made it very clear, as the governor's indicated, that rates aren't going up anytime soon, and that's all fine at present. There is a potential, however, for markets to start pricing in either interest rate increases sooner than our policymakers probably want at this point in time, or in fact starting to price in kind of higher inflation as we go forward. And then that's as we get into the summer period. If you're talking about, if you look at the numbers folks have got out there for growth, 4 or 5% growth for a couple of years in a row, either at the global level or various economy levels, there will be a point where you look forward and you see there's this massive growth expected, and that's going to pressure central banks to try and either allow market rates to drift up to maybe levels that they're uncomfortable with, or they might be forced to try and come in and use yield curve control or other techniques to try and maintain kind of financing conditions in a kind of a range that they're comfortable with. And that, I think, is going to be a challenge for central bankers to navigate over the next 7 or 8 months.
Okay, thank you for that. We've already begun to dip our toes into the water of fiscal policy. There's large calls for advanced economy fiscal support to bridge shortfalls until the pandemic is overcome in particular. There appear to be new debates about fiscal policy. Contrary to past conventional wisdom, we're told we should be less concerned about rising debt GDP levels, given that inflation's dormant, debt service costs are low, the need to worry about secular stagnation, stall speed, and the like. Others remain concerned about a buildup in debt, even if they recognize the case to spend now. So what's your view on the proper stance of advanced economy fiscal policy now and into the future, and we'll get to Canada in more specifically in a minute.
Let's take it from the viewpoint of small open economies. It doesn't matter whether it's Canada, the United Kingdom, or Argentina, any. I mean, there are very real limits in the end. And what are those limits? The limits of the amount of debt you can build up is your ability to service that debt going forward. And so as we look out through the 2020s, look forward, the question is, given the buildup of debt that we have undertaken, and we certainly in this country, and I think we're looking for in many other countries, will continue through 2021, whether that buildup in debt is going to create debt service costs out there as we get towards the end of the decade, that are going to be very, very difficult to manage. And because one has to look at rates going up, at least up to, let's say, the level of the last 20 years, which is basically 1% below growth, or going up to the more long-term average where interest rates will run around the same rates as growth. And once you get into that, those very high levels of debt that we're building up really do begin to create a problem. And so the real question on how much you can keep on going, because I have a lot of sympathy for the, let's call it the Larry Summers view of the world on the role of fiscal policy, but there's a very real limitation out there, and I think we have to bear that in mind, and that I think is important to talk about, and it does point to one thing, and that is that to the extent governments are running up debt, or indeed, let's say the extent to which private sector is running up debt, so that the economy as a whole is becoming net indebted in large amounts to the rest of the world, then that does certainly create a limit going forward. So I think one has to watch carefully the debt side, but I don't think the debt to there is no particular debt to GDP ratio that does it, because you've got to look at flows, and debt to GDP is a funny measure. It's a stock to a flow. And if you look at the flow side, which is the debt service cost to GDP, that's where monetary policy really does matter. And so if we're going to have monetary policy that keeps interest rates well below growth for a long period of time, or that central banks are going to be forced by treasuries to keep interest rates well below growth for a period of time, then the debt situation isn't the same. On the other hand, once interest rates rise to growth rates or above growth rates, then indeed accumulated debt really does matter.
Jean-François.
I would just maybe add a couple of things to that. So it's, if you look at the experience of savings behavior over history in the presence of big shocks, right? Whether they're big recessions, natural disasters, housing market crashes, those kinds of things, what you see almost consistently is that savings rise very, very significantly, not nearly as much as they've risen over the last few months, but they rise very significantly, and they stay elevated for a long period of time. So as a result of that, you get a kind of a secular decline in the neutral rate of interest. And it's possible that what we're experiencing now, even though we think savings are going to be drawn down and spent over the course of the next year or two, it's possible that the pool of global savings remains elevated, perhaps rises going forward relative to investment, so that you in fact have this kind of excessive savings that needs to go somewhere, whether it's government bonds or bills or equity markets or other financial assets remains to be determined. But I think we're underplaying that dimension a little bit in terms of how that might play onto the fiscal side. But I would also add that one of the things that I think markets take comfort from now is there's a clear sense that what's being done on the fiscal side is necessary. Probably overdoing it, but better safe than sorry. But there will come a time at which one will start to question what you're achieving with fiscal policy, right? So, in countries that have very high savings rates, for instance, or where savings have accumulated, and for instance, firms aren't spending, what more can governments do? What's the point of doing more kind of government stimulus if that's just ending up in bank accounts or if it's not going anywhere? And that's, I think, one of the things we'll have to watch over the next little while is if there's more evidence that fiscal policy doesn't have all that much traction relative to the amount of firepower you're deploying, going forward, then that undermines kind of this notion that fiscal policy is really kind of helping sustain growth going forward. And if you get into this, to the governor's point, where R becomes, a challenge from a G perspective, then I think you get a little more questioning about what's sustainable and whether or not interest rates are going to remain at current levels and all this kind of stuff. We're not there yet, but that's certainly a risk that we think about as we go forward. It's kind of the analog to kind of pushing on a string from a monetary policy perspective. Can governments really turbocharge investment? Can governments really force us to spend if we're not comfortable doing so?
I think Jean-François has raised a really important point, and these are the debates I think that are going on. When we talk about fiscal policy, what we've really been referring to is budget balance. But the other part of fiscal policy is how you tax and how you spend. And one of the key things is that if we observe now really the last 30 years, we've had structures in our Western economies that in fact have tilted the world towards excess savings. And those structures are, we've allowed income distribution to widen out, and we know that most of the savings in the household sector all comes in the top 20% of the income. And so that's where, if you look on the household side, where the savings have built up. And if you look in the corporate side, we've had tremendous global corporate concentration. And we see the savings building up, or let's call it the unspent retained earnings building up on the corporate side. And so the other part of fiscal policy is how we tax in order either to, with respect to distribution on the household side, or in terms of competition policy on the corporate side, how we tax in that regard, and what incentives we throw up in other parts of our policies to invest and to consume. So I think there's a lot to be said in looking forward about what we're going to do in terms of our Western economies, at any rate, in terms of these policies, which have created since the early 80s, since Mr. Volcker and Mr. Bowie did their thing to try and deal with our problems of the 70s, have created this gradual drift to a savings glut, or however you want to phrase it.
Good. Let me ask the governor just for a 1-minute question, a 1-minute answer to a question before we turn to Canada. Do you worry about fiscal dominance, central banks losing independence?
Yes. Yes. I mean, that's been the history. The history since kings clipped coins. That has been the history. And that, of course, was our history after the Second World War, where we had enormous financial repression. And so it's not very far back that we've had treasuries. And if we look at the United Kingdom, of course, it's very recent that there was a degree of central bank independence. So I think central bank independence is a fragile flower that one has to nurture carefully because we don't want to have a repeat of the situation we were in the 70s.
I wanted to just throw you that softball. So turning to Canada, let me start with JF. Sorry, let me start with the governor, and then I'll give JF the last word. So Canada has allowed a huge jump in its debt, nearly 20% of GDP. Your debt levels were relatively low to begin with. Some are questioning whether the buildup in debt in Canada yielded better growth performance than others. Others fret about a premature withdrawal of support. There's a debate I was reading about the future course of fiscal policy and whether consolidation guardrails or rules are needed. So what are your thoughts on the Canadian fiscal debate, and do you see a role for state contingent fiscal consolidation policy?
Yes, so I go to the issue that I raised earlier, and that is, are we going to be able to service the public debt that we've built up? We've talked a long time about our households in Canada. Are they going to be able to service certainly the bottom three quintiles or even four quintiles of the household side? Are they going to be able to service the debt? So the issue then is the same for the federal government and for the provincial governments. Are they going to be able to sustain the debt service payments going forward? And the answer there, as I said earlier, is contingent upon where you think that monetary policy is going to end up being, where interest rates are going to end up being. But I think under reasonable circumstances, under reasonable assumptions in that regard, that sometime probably before the end of the decade, but about then, we're going to have a situation where debt service costs are going to be eating into government's abilities to deliver real goods and services. And so that's a political constraint. When governments are delivering only 75 or 80 cents worth of services for every dollar that people are paying in taxes, that becomes politically unsustainable, just as it becomes an indicator that things are not sustainable on the financial market side. How big is that risk? Well, we've been doing some simulations looking at that. It's not absolutely threatening as it was in the early 90s, but we will get debt service costs to revenues running up well above 10% under reasonable circumstances, and that's the real danger zone. And so my rule is that once you do those simulations going forward and seeing that you're going to likely be running well over 10% of your revenues are going to be absorbed in servicing past debts, then that is the real danger zone. And that's the one I think ought to serve as the appropriate guardrail for governments. And for the federal government, it's flashing orange at the moment if the federal government proceeds with the policies that got laid out in the most recent economic statement, but can be mitigated if in fact those expenditures are all devoted to raising future GDP, which has not been the case to date.
I mean, I agree. I mean, we're largely the same view. I would add a little twist on that issue, though, which is, as we think about guardrails, and for instance, in Canada, the finance minister in her most recent economic statement laid out, some economic variables that they would look at to help them determine when the right time is to start unwinding some of the stimulus measures. I'll take it back, just in a bit of a strange way, to the central bank independence question that the governor discussed, which is, the central bank's got a framework within which it conducts its operations, stabilize inflation 2% over a period of time, looks at the output gap to do that. It's kind of got this pretty established way of setting policy based on how it assesses kind of the normal economy, if you will, a steady state economy. When you layer in a fiscal authority that has a different set of criteria to say, this is when we're back to normal, this is when we think we can start unwinding stimulus, then you've got this conflict between, your potential conflict between, who's got the right framework to assessing when is the time to withdraw stimulus. And, very clearly, the government's going to do what the government wants to do, and the bank is going to be the one trying to, figuring out a way to explain why they're doing things that may not be consistent with, the characterization of the economy that the finance minister of the time will want to go forward with. So, that to me is a non-negligible risk in terms of, central bank independence, but also perversely in terms of the government's ability to manage its own fiscal affairs. Because if you start to get into this world where, there is a bit of a tension between the two, then you have a bit of a risk of losing control of inflation expectations, a little bit of a risk related to longer term interest rates, and that can have, obviously, if they start going up in as a result of risk premium or things that are kind of non-fundamental, that just exacerbates any potential debt issues. So it's a bit of a, this guardrail issue is a bit of a double-edged sword. I mean, you want governments to think forward-looking and to kind of lay out what it will consider, some of the factors that will, underlie its decision to move forward with the consolidation path. But it's really, I mean, I think it's really tricky business.
Yeah, governments only last for 4 years. Only have at most a 4-year time frame looking forward historically, and that is always the danger on that side. On the other hand, if in fact we had a new agreement between the central bank and the government of Canada as to how things are to proceed, seems to me, I mean, I really like the existing framework, and I wouldn't tinker with it for the bank. But I would add one component, and that is there's an obligation on the part of the fiscal authority, certainly from the fiscal balance side, to work in concert with the aims of the central bank, with that 2% inflation target. And that gives you a coordination between the two. It does mean that appropriately, when there's a lot of excess supply in the economy, the fiscal authorities will have a relatively expansionary policy as the central bank. But when inflation starts to rear its head, as it will, then both authorities, the monetary authority and the fiscal authority, have an obligation to try deal with it. So I think that would be the sort of improved agreement framework. Whether this government in Ottawa will be able to bring itself to that point, I'm not sure. And finally, just I think the key point in all this is what you focus on as the appropriate measure of excess demand or excess supply. Our big problem in the 70s, at the end of the 60s and right through the 70s, was the government's focus on unemployment, which was tending to run high by historic standards. As we had all these kids flooding into the labor force, we focused on unemployment, forgot about the inflation side until we were in real trouble. I mean, forgot about it. We tried all sorts of things. The Nixon controls, the wage and price controls here, all of those crazy things that we did to try deal with it, because essentially on the fiscal side, we didn't accept that at that point in time, if you will, the natural rate of unemployment was in fact quite a bit higher. And I do worry if there's too much focus on unemployment without the focus on inflation as a measure of the degree of excess demand or supply in the economy, that one can get off track this time. That'll be for governments from 2025 to 2030 to worry about.
Well, good. We always have something we should be worried about. So thank you for that comment. It's early in the day. Both of you probably have day jobs you need to run off to. So I want to thank Governor Dodge and my longtime colleague, Jean-François Perrault, for this fascinating discussion. Thanks for being here today.